Good morning to all of you.
Good morning.
Welcome to our class. Now, yesterday, we did start off, okay, with our first topic, okay, and we did discuss on what the scope of financial management is all about. The three decisions we say that should be covered under financial management: the investment decision, the financing decision, and the dividend decision. So I think we did discuss them in detail. Okay, we went ahead and said that at Thursday, okay, financial management, as you say, is the management of the company financial resources with the key purpose of helping the company or assisting the company to achieve its financial objective, to achieve its objective. Okay, so the key thing is about achieving the financial objective. We went ahead and said that there are three core financial objectives that a firm ought to achieve. Okay, we have the first one we discussed was on profit maximization objective. Okay, it was on profit straight. Okay, was on the profit maximization objective. Okay, we say that the idea of the firm, okay, here is to increase the amount of revenue they earn from their different asset base, okay, and of course to minimize the expense they incur in earning that revenue. Okay, it's about trying to minimize the cost and maximizing the revenue. Okay. However, we see that this goal in itself is not the best of the goals, okay, to pursue because of a number of limitations, which I think we did go through together. Okay, so he said it's worth enough for a company not to just stick to this objective. Okay, so it's a good objective for sure. Okay, because the company is a commercial company, is a commercial entity. Okay, however, it is not the best of the objective for the company to maybe always be pursuing. Okay, so it's worth enough that we try to see. Okay. Are there other objective that the company can pursue? Are there other better objective? Okay, so the other include better objective the company can pursue. Okay, where we start off today is on shareholders wealth maximization. Okay, shareholders wealth maximization. Okay, and so in this goal, okay, so I seem to have chat here. Slides are not clear. Okay, Brian and Sanya, are they clear now or they are still not the best?
Okay, mine is blurry. I can't see too clearly.
Even now?
Okay, it's better now. It's better now.
No, it's better. Sanya?
Yeah, it's better.
Yes, it's better now.
Okay, great. Okay. So on the shareholders wealth maximization, okay, this objective, its main idea is that at the end of the day, what does shareholders want? Okay, if I am a shareholder, if I was have the intention of investing in, let's say, just a simple example, shares of Safaricom, okay, I have an objective which I want to achieve. If my time of investment is 3 years, if my time of investment is 5 years, by the end of the 5th year, there's a goal I had, okay? I might have a decision, I might have a target, for example, that in 3 years' time, I need to have my wealth, my share value increasing by 20%, for example, okay? So generally, there's an objective that shareholders want to achieve, and of course, it's about maximizing their wealth. Now, the question remains, therefore, is that how, therefore, do we evaluate the wealth of the shareholder, okay? The wealth of the shareholder can be evaluated using 2 ways, okay? One is trying to observe it from the increase in the share price, okay? You bought the share for 20 shillings, okay? This was last year, for example. Now, this year, what was the price of that share? It was 20 last year, this year it is 27. So we can say that the share price has increased from 20 to 27, okay? Which means, therefore, my wealth as shareholder, okay, I did invest 20, I got a return of 7 shillings, okay? That's a good investment. It's a good return you have received over a span of 1 year, okay? But over and above that, you can also receive the dividends also, okay? If the company is a dividend payer, okay, if the company is a dividend payer, then of course, on top of the increase in the share price, you're going to be adding the dividends also, Okay, so the return to the shareholder, therefore, can be evaluated from two perspectives. One is increased share price, and you have the dividend you'll be gaining over that particular time period. Okay. Now you go back, what would make, therefore, for the company to be able to, what would influence the share price? What would make the share price to increase, okay, from 20 to 27? It can't just increase out of hot air, okay? The market need to see, okay, what have you done as a company to warrant us to demand more, okay, of your shares, okay? But don't forget the share price will be influenced by how the market demands of you, of the demands of the shares that you have, okay? So in case there's more demand of your shares, of course, therefore the share price is increasing, which means therefore your wealth will also be increasing. Okay. So therefore, the question remains, therefore, we as the managers, okay, we as the management, okay, who are in charge of running the company, overseeing how the company is being run, okay, we need to see on what investment can we make, okay, that will increase the value of the company. Okay. And generally, we said in capital theory, okay, this is not always a guarantee, but generally, okay, if as a company you do invest in value-adding projects, if as a company you're going to be investing in value-adding projects, what we call the positive net present value project, then of course you'll see your wealth increasing. Okay, you'll see the share price increasing because the market will be demanding more of your shares. Okay, so it's about investing in value-adding project, positive net present value projects. Okay. Let me just maybe just to make a mention on the NPV. Okay, just to make a mention on the NPV, the net present value. Okay, something is not wrong. Okay, okay. Yes. Okay. If, for example, okay, we are to invest in a project, okay, the cost of the project, this is too big. Okay. So the cost of the project, okay, assume is equal to $10 million. Okay, that's what the cost. We evaluate, okay, what is the cash flows, okay, how much cash flows in present value terms. By present value, we mean the money you'll be earning from this investment based on today's value, okay? How much cash do you get from this investment, okay? And assume that you get, let's say, 13 million, okay? So you did invest 10 million, you got back 13 million in terms of cash flows, because therefore the excess you earned was 3 million, okay? That means therefore this project has a positive, what we call net present value. Net present value, net is 13 minus 10, can give us a net value of 3 million. We can see therefore if you invest in this project as a company, they imply therefore the value, okay, of the company will be increasing by 3 million, okay? The company's value will be increasing by 3 million. And of course, by implication, okay, the share price will also be increasing, okay? By implication, the company share price will also be increasing. If you have to invest, okay, in a project with a cost of 10 million, as it is here, but the amount of cash you get from this investment, in the cash flow you'll be getting, for example, is 9 million. That implies, therefore, if you invest in this project, you're going to be getting back 9 million, but you spend 10 million. Of course, therefore, in that case, therefore, the value is negative 1 million. Of course, therefore, you reject this project because you're spending more than what you're getting back. So this is not a very good value adding project. If anything, if the company goes ahead and invests in this project, then the value of the company will be decreasing, okay? It will decrease by 1 million. In this case, it will increase by 3 million. Therefore, you as manager, okay, the only way you can increase the value to the shareholders, increase the wealth of shareholder, is by investing in value-adding project, in positive NPV projects, a positive net present value project. That's the best way you can increase the wealth of the shareholder. Okay, we are assuming that the market is going to be appreciating, okay, the project we are investing in. Okay, Don't forget that the kind of cases where the company investments are good projects, okay, they are value-adding projects, okay. However, the market does not appreciate the projects, okay, through the share price. So, but we are assuming the market will be appreciating, okay, that in case you are investing in good projects, then the market will be appreciating those projects, okay, by the increase in the share price, okay. That's the assumption we are making here, okay. Because this question, by the way, has been asked in the past. How does the NPV, okay, influence the wealth of shareholder? Okay, in short, what's the connection between the net present value and the increase in shareholders' wealth? Okay, it's one of the questions that the examiner has asked in the past. Okay, maybe just repeat. You'll see that if you are to invest in a positive NPV projects, okay, for example, this 3 million, okay, and they imply therefore the company's value will be increasing by 3 million. And by extension, the share price, okay, the share price was be increasing in line with the value increment, and as a result of investing in those projects. If the company was invest in negative NPV projects, okay, if anything, if the company goes ahead investing there, like in our case here, the 1 million here, okay, it means therefore the company's value will be decreasing by 1 million. Okay, the company's value will be decreasing by 1 million. And of course, the market will be reacting towards that. The market will have, the share price will decrease because the company has chosen to invest in value-adding projects. Okay, these are not value-adding projects. Okay, that's a discussion you're meant to have there. Okay, now, okay, let me see if I can get that question, by the way. Okay, if you're new, but I think I've seen some new names. Okay, so there's a question bank, okay, for those who are new, okay, which is on the e-learning, okay, which shall be using to get to understand the examiner. Okay, so there's a question bank on the e-learning which can help us in getting to understand the examiner. So if you're new, I propose that you check on the e-learning. Okay, I hope you know how to navigate through. Okay, password is Acca F9. Okay. Let me just pick one of you, the one who have seen a new name here. Elvin.
Yes,
How are you?
I'm fine.
You know how to navigate through the e-learning?
Yeah.
Okay, so in case you just check on the course F9 Financial Management, where Dominic Minor, okay, I'm Dominic Minor, by the way, okay, is a lecturer. So if you click on it, it will ask you for password. It's the key, and the key is maybe Acca F9. Okay, so I hope we can be able to navigate through. If you don't know how to navigate through, you can ask me. I can show you to the end of the class. Okay, so if you ask for a key, Acca F9. Okay, and the question bank is already there. Okay. So I want to check on the examiner. Don't forget the key objective with professional papers. You have to pass. That's the intention of doing. You must have that as at the end of it, at the back of your mind, that you must pass this paper. Okay, that's why I normally refer back to the examiner. I'm not the one who will examine you. Okay, you all know that for sure. So we have to understand. We have to understand the examiner in and out. Okay, by going through the past papers. So the question I'm asking, I want to check. Trying the relation between the NPV and the shareholders' wealth maximization. Okay, is a question the examiner has asked in the past. Okay, if you see it, let me know. And the one who have the question bank already. Here it is actually. Okay, this is page 7. Okay, page 7, question 4. A company called CS Company. CS Company, page 4. Page 7, sorry, page 7. And part D of the question is asking us, discuss how the net present value method of innovation appraisal contributes towards the objective of maximizing the wealth of shareholders. You can say these are 5 marks, okay? So that imply more discussion. You have to have more discussion for sure, okay? But it's simply the way I've just mentioned, okay? Simply exactly the way we have discussed together, okay? That in case you're going to be investing in positive net present value projects, then I don't know, you can even give example. Therefore, like the way I've done, okay. that if, for example, you have a project that has a positive NPV of 3 million, now what does it mean? It means that in case you have to invest in that particular project, then the company's value will increase by 3 million. And you're saying by extension, the market will be appreciating the company investment they have made in those value-adding projects through the increased share price. Okay. However, if the company will be investing in negative NPV projects, then of course that implies therefore, and if the NPV is negative 1 million, then it means therefore the company's value will be decreasing by 1 million. The company's value will be decreasing by 1 million. And of course the market will be reacting towards that. The market will have to react, okay? That hey, the share price will have to drop because the choice of investment the company has made is not value adding. Okay? It is, if anything, is decreasing the company's value. So there will be a drop in the company share price. And don't forget, we say that the wealth shareholder is determined by the increase in the share price. One of the key components of the wealth shareholder is the share price. So if the share price is increasing, an increase in wealth. If the share price is decreasing, is a decrease in the shareholders' wealth. Clear? Brian, it's clear. You can discuss on your own.
Yes, I believe so.
Okay, great. Because those are 5 marks, and that might mean you passing or failing. So it's good enough that even the key things you can be able to understand. Nelson. Nelson.
Yeah, my skin has been blurry.
Okay, it is even up now.
Not yet.
Okay, but you heard how you can approach the question.
Oh, now it is clear. Now it is clear.
Okay. But you heard how you can do the question.
I'm not sure yet.
Okay, should I repeat or what do you want?
Yes, please repeat.
Okay. So you say that if the company, you have to invest in positive net present value projects, okay? If the company you have to invest in positive net present value projects, okay? And I go to the example that we have done together, okay? A case where the NPV, okay? We had the cost of the project was 10 million, okay? The cost of the project was 10 million. However, the amount of cash we earn from this investment in present value terms, in today's term, is 13 million. So what's the excess? 3 million. 13 minus 10, the 3 million. That implies, therefore, if you are to invest in this particular project, okay, that means the company's value will be increasing by 3 million, the value of the project, okay, the 3 million, okay. And you say the market will be observing, okay, in short, the market will be observing, okay, the choice of investment you are making. Okay, so since this is a value-adding project, and of course the market will be reacting towards that through an increase in the share price, okay. And if the share price is increasing, then of course the wealth shareholder is increasing. Don't forget to say that one of the key components of the return to the shareholders is the capital gain. It is the increase in the share price. Okay. If as a company you have to invest in negative net present value project, an example, okay, you invest in a project costing 10 million. The amount of cash you get from that investment in today's value is 9 million. You spend 10, you get 9. Okay, therefore, the value of this investment is negative 1 million. Okay, but I mean, therefore, if we invest in this project, the company's value will be decreasing by 1 million. The market will have to react towards that, okay, by the share price decreasing. Okay, a decrease in the share price means a decrease in the wealth of shareholders. Okay, that's what you're meant to discuss for 5 marks. Okay. It's clear, Nelson. I hope it is clear.
Yeah, it is clear.
Okay. Yeah, I guess you download the question bank. I guess you download it from the e-learning so that you can also be able to mark the question you have gone through anyway. I propose that you download the question bank. If you don't know how to get to the e-learning, you can let me as we end the class. Okay. Anyway, and then don't forget to say that we need to evaluate. Okay, we need to make an evaluation of the impact to evaluate. Okay, the wealth of shareholder. Okay, And you see that the return to the shareholder, okay, is made of two components. One is the dividend you make, and of course the other one is the increase in the share price. Okay, so you can see shareholders' return wealth, shareholders' wealth is equal to the capital gain, which of course the increase the share price, capital gain, and we have the dividend. So those are two things that makes up the return to the shareholder or shareholders' wealth. Okay, capital gain is the increase the share price. So let me call this is P1, the share price end of the period. Okay, minus P0, share price beginning of the period. Okay, that's give you the capital gain, and you have the dividend. Okay, let me just refer to as D. Okay, and that therefore gives us therefore the absolute return to the shareholder. Okay, the absolute return to the shareholder. Okay, conventionally we don't use the absolute terms. Okay, we use the percentages, for example. Okay, so use therefore most often than not what we call the relative terms, the percentages. Okay, would of course be therefore P1 minus P0. Okay, don't forget we need to evaluate what was the beginning of value, which is P0, the share price beginning of the period or the year, for example, divided by P0. Okay, plus the dividend you made, we divide by your initial investment, the P0, the share price beginning of the year. Okay, and of course we express as a percent. Okay, no, these two are the same. The only difference that here, this is the absolute terms. Okay, and here is the use of percentages. That's the only key difference. Okay, maybe where P1, P1 is share price end of the period, share price end of the period. P0 is the share price period beginning. And of course, D is a dividend that have been paid during the period. Okay, it will have been received during the period. And that's how we evaluate. As I've mentioned, if the company was to invest in value-adding projects, then of course P1, the share price, will be increasing. And of course, if it is increasing, of course, therefore, the return to the shareholder, the other shareholders, is increasing. Clear? Collins? I hope Collins is in class.
Yes, clear.
Okay, great. Okay, so let's do an example.
So I have a question.
Mm-hmm.
The figure of the capital gain, where do you get it from?
P1 minus P0. That's the capital
Oh,
gain.
it's the absolute return.
Yes, okay, both of them. Okay, they're both capital gain. Okay, now here, let me just.
Oh, okay.
So this is the capital gain component. Okay, and this is the dividend. Okay, this is the capital gain. Let me use a different color. This now is the dividend bit of it. Okay, if you use percentages, then with this we call
okay.
This one we call it the dividend yield. Okay, let me just use it. If you use the percentages, then this is called dividend yield. And this is the capital gain component. Okay. Yes, Anya.
Yeah, got it. Thank you.
Okay. Okay, so we can do an example. Let's do an example, a hypothetical example. Okay, let me just cover an example. So, example, Mr. A bought shares of Safaricom, on 2nd of January 2020 at 23 shillings per share. But 1st of March 2020, a dividend of, let's say, month 3, a dividend of shillings. was paid. On 1st of September, we are in September already. On 1st of September 2020, a final dividend was paid. A final dividend. Final dividend was paid. A final dividend. Final dividend of, let's say 1.5. A final dividend of 1.5. The dividend of 1.5 was paid. Determine A, shareholders return, total shareholders return, on 1st June, if the share price 10, was, let's say, 25, and B, capital gain and dividend yield, capital gain and dividend yield, and total return today is 29th. On 28th September 2020, and the share price was 26.5. Okay, this is a simple example to apply what you've just learned. Okay, so go through it, then we attempt to do it together. Okay, I suppose that you have gone through it and you can attempt to do it together. Now, the first bit, you want to get the return. Okay, don't forget the return is at a specific point in time. Okay? So in this example for part A, you're being asked to get on 1st of June. Okay, so we must get all the share price at that point in time. Okay, which is this case, you've been told is 25. Okay, so let's do it. Also, the return of the shareholder, okay, conventionally, we use the percentages, okay, unless you've been told to use the absolute terms, we use the percentages, okay. For example, in this example, you can say that for the return to the shareholder, okay, the return to the shareholder will be equal to P1 minus P0. Let's give you the capital gain, okay, as dividend. Plus dividend, of course, in percentages, so P0 we divide by P0. P0, the share price, beginning of the time period, in this case, the 2nd of January. Therefore, the capital gain component will be equal to P1 is share price, which is 25 minus share price, P0 beginning on 2nd of January, which was 23.5 or just 23, was 23, okay. We divide P0, which is 23. Let's give that the capital gain part of it. Okay, the dividend, don't forget, we are evaluating between 2nd of January all the way to 1st of June. Okay, and I think in between on that 1st of March, there was a dividend that was paid, and the amount of dividend paid on that 1st of March was dividend of 2. Okay, here 2. Okay, therefore the dividend is 2. Give us 2 divided by 23. Okay, of course we express them as percentages, both of them. Okay, capital gain part, what do you get?
8.7%.
8.7%. Okay, and the dividend yield?
8.7.
8%. Okay, 8.7. So combined give us 17.4%. 17.4%. Therefore, the total return to shareholder between 2nd of January and 1st of June has been 17.4%. Okay, a very high return for sure. So yeah, that's the return that the investor will be receiving between those two time periods. Clear? Question? Okay, so no question. Now I want you to attempt B. So attempt B. Let me see if I can go. Okay, in the next 2 minutes. So attempt B in the next 2 minutes. Then one of you will take us through. Okay, part B.